Hello, everyone. Welcome back. My name is Mayur Thaker. I am an analyst and co-portfolio manager here at Zacks Investment Research. And today we're talking about a subject that I think does not get anywhere near the amount of airtime that it should. And that is this third idea called quality. We can typically or traditionally define investors into one of two groups, either value or growth. But there is a third way that more and more seasoned investors are starting to talk about, and that is quality. And this idea has been embedded for decades in some of the best legendary investors of our time. But it needs to be brought out a little bit more into the general investment community because I don't think it gets anywhere close to the amount of time and attention that it should. So in this presentation, we're going to talk about the factor that is quality. And I wouldn't call it even a factor because that kind of implies that it's a quantitative approach, but rather the investment style that focuses on investing in businesses of high quality. And I believe personally that quality is the true driver of long-term shareholder value. And that's the way that I'm going to define quality here in this presentation. So let's talk about it a little bit more and understand what exactly it is. So what is quality, right? So we can define it as just two, broad ideas. One is consistency, and number two is durability. That's it. So these are two ideas that are related, but still different enough for us to break them out apart and to take a look at each one, individually. Let's talk about that. So first is consistency, right? So what do we mean by consistency? We are looking for companies that show consistent earnings per share growth, consistent free cash flow conversion, and we'll talk about exactly what that means in a second here. And number three, consistently attractive returns on invested capital. And so combined, these three factors will tell you the business's past financial performance, management's ability to allocate capital, and the business's sensitivity to past economic cycles, shocks, macro difficulties, recessions, things like that. So we want to look for companies that have a proven track record at these three things. We want consistent earnings per share. That's, quite easily understood. But we also want, as an overlay to assess the quality of those earnings growth, we want free cash flow conversion. So what does that mean? We want to see companies that are able to translate their net income substantially into free cash flow. So let's say a company earns $1 of net income. We want to see as much of that $1 show up as free cash flow as possible. Because remember, earnings are a mix of both cash accounting and accrual accounting. Going back to the accounting, textbooks. Earnings can be a mix of both. So it doesn't necessarily mean that if a company earns, let's say $1 in net income, that dollar actually was, credited to the bank account at the end of the day. It could mean that they earned $1 on paper, but they only collected 50 cents of that. And that 50 cents is what, was actually credited to their bank account. So that would be a free cash flow conversion of 50%. So we want companies that have a very high conversion rate between earnings and free cash flow. The higher that conversion rate, the higher the quality of earnings. And we can go back and use textbook examples of companies that have failed to do this for a long period of time, and that's how they get into trouble. Going back to Enron, as an example, earnings per share looked tremendously good for Enron for a very long time, but they were never able to produce a coherent cash flow statement. In fact, the CEO laughed at an analyst at one point on their earnings call when they asked about free cash flow conversion. and they thought that the guy is an idiot, or he kind of cursed at him and wrote him off. That should have been a red flag. So, and this is kind of ongoing as well. GE, for example, now GE didn't have fraud in the case of Enron, but GE had significant troubles with their businesses, and their free cash flow conversion really deteriorated for over a year and a half, way before the stock price ultimately cratered. So we can actually look at this in ZRS and Advisor Tools if you have a subscription to that, and you can see these relationships occur and be able to get ahead of deteriorating earnings quality. So if a company is growing earnings per share, but if the free cash flow conversion is going down, that is a major red flag. So we want consistency in earnings per share growth, but we want to also see a substantial amount of earnings per share translate to free cash flow. And as a general benchmark, some of the best, highest quality companies out there translate roughly 80%. That's kind of a sort of a rule of thumb that quality-oriented investors like to talk about. 80% is typically that rule. So if a company earns $1 of earnings, you want to see at least 80 cents of that show up as free cash flow. That's not a hard and fast rule. Surely some great companies out there do 75% free cash flow conversion. Some do 70% free cash flow conversion. But overall, you want to see that number gravitate to 80% at least, and at least stay consistent. That's the other key too. So if they do 75%, no problem. But as long as it stays at 75% consistently, that's also okay. But you don't want it to be too low either. You don't want it to be at 50% consistently for a long time either. The key is you want to see some rate of change or improvement. If it is low, you want to see it improving. You want to see a trend develop over time in improving from 50%, let's say, to 60%, to then 70%, and so on. So again, the key is to look for a high conversion rate or a rate of change in improvement. That's what we want to see. And then lastly, consistently attractive returns on invested capital. This tells you how strong is management at allocating capital. This tells you what is the rate of return the business is earning on its own investments. And over time, academic studies show that ultimately the stock performance will track the return on invested capital that the company earns on its own investments. So if a company earns a 10% ROIC, over 20 years' time, then you will earn a return of 10% on that investment, almost irrespective of the multiple that you paid. So compound interest is what ultimately overwhelms valuation in the long run. So what we want to do is we want to find companies that consistently earn high returns on invested capital. And typically we'd like to see that in the ballpark of 15%. But certainly great companies can still earn 10% and do quite well as well. So we want to see all three of these come in, and combined, these factors tell you how well and how high quality of a company that they are. Now, the second aspect of it is durability. Remember, we have two sort of definitions of quality: consistency and durability. So consistency tells you how well have they done in the past. And then durability tells you about how well they will do in the future. Because remember, we're investors, we're interested in the future, not the past. The past is very important because it does tell you how well the business has done in volatile macroeconomic environments. That's a great piece of information. But then we have to do a little bit of additional due diligence to basically assess how they did it and whether that can continue into the future. So if a company has had great consistency in earnings per share growth, if a company has had high free cash flow conversion, and if a company has had attractive returns on capital, that's a great first step. But then the next step is to understand whether that trend can continue into the future. So how do we know whether those trends can continue? There's a couple of tidbits that you can really get to understand that and to significantly bring the probability, the odds into your favor. You can bring and increase the edge you have over the market by answering some really basic, fundamental, sort of first principles questions. Is the business focusing on needs or critically required products and services? Remember, you could have consistent growth, but what if you're in an industry that was a fad for 10 years, right? Or what if you were, in a, just a bull market where everybody had, excess savings and therefore they bought, the new shiny object for quite a while. There are companies that have had great long runs, but ultimately provide a nice to have or a luxury, and not something that is critically needed all the time. So we like to focus on companies that provide great products and services that are needed by society. As long as there's a population, there is a need or a market for your product. So we love to focus on companies that provide and service and cater to needs or critically required, items. We love to find companies that solve a pain point, or they cut costs or increase utility. So imagine if you can do both. That would be great. Now, by the way, companies don't necessarily need to check off all of these boxes, but we want to see them check off at least a few of them, more than just one. So out of these four, I would, really like to see them check off at least box number 4 or, point number 4, plus one other one on this list. So are they solving a critical need? Are they solving a pain point? Are they driving down costs for consumers? Or if they're not driving down costs, are they increasing utility? So are they delivering value to customers? Meaning, are customers getting more per dollar of spend overall, either by cutting costs and providing the same service, or increasing, the utility that customers get per dollar of spend. So these are all sort of intangibles. They're not always, quantitative metrics that you can, get from a database. This is additional due diligence that you'd really want to see by listening to their earnings calls, or reading their shareholder decks, watching their presentations that they've done. Just try to get tidbits from their communication from management that talks about how they're either driving down costs without sacrificing on quality, or increasing quality without increasing costs, or increasing quality at a higher rate than increasing costs. So overall, we want to see companies deliver greater value per dollar. We also love to see recurring or subscription/lease revenue. So this is also a great way to assess whether a past trend can continue. Because if a company has, for example, historically grown earnings at, say 10% consistently, then there is a high chance that that can continue if a substantial portion of that earnings is being driven by subscription revenue. And remember, if you're doing a subscription of a critically needed item, that again brings the odds tremendously into your favor. So we're going to get into 2 examples of this in just a minute here, but these are all tidbits that, are great, sort of additional due diligence that can bring the odds tremendously into your favor, into being able to predict whether a past trend in earnings and free cash flow and ROIC can continue into the future. Does the company have a substantial amount of their revenue in the form of subscription or lease revenue, which is recurring in nature? And then I should have actually, I wrote this here. This is 1, 2, 3, 4, and 5. So number, 4 here, brand value. This is a very, very key metric. Academic studies have shown that companies that have strong brand value are the ones that deliver the best returns on invested capital over time. Because when there is brand value, customers willingly pay more to buy your product or service. That is a study after study after study. You can read them. You can find them online. But studies show that customers ultimately do and are willing to spend more if they can buy a product from a trusted brand. And that is a durable moat that has continued over the long run. So is there a brand behind the name? Is there a great product experience? Are customers loving the product? Again, these are all tidbits that you can get. Sometimes companies communicate the Net Promoter Score, for example. That is a very, very important metric that helps you understand the customer experience overall. Do customers love the product, and therefore are they telling their friends and family to buy it? So how customers behave with this company's products or services is key to telling you about the customer experience. Does it have a great product, and do they provide great customer service? Again, Net Promoter Score is a great sort of tidbit to help you understand, or to help you answer the question whether a past trend can continue into the future. So companies that have great Net Promoter Scores will typically communicate this. They'd be happy to tell you this on the either in a presentation or on their earnings calls. And then lastly, strong capital allocation. This is critical and in my opinion required. Are they investing in themselves? Why should you invest in a company that's not investing in themselves, right? I always love to come back to this. There are cases where it can still provide great value because companies that are in the end stage that aren't growing as fast can still be good investments if they are providing a great shareholder return in the form of dividends and buybacks. But if you're looking for strong long-term secular growth, you want strong capital allocation. And the question is, are they investing in themselves? Are they reinvesting cash flows back into themselves at an attractive return on invested capital? That's a very, very important question to ask. So combined, these factors tell you about the business's ability to continue high performance into the future. So these are all key questions that we want to ask here. So we have two case studies. One is American Tower and the other is Checkpoint Software Technologies. We'll take a look at both of these companies here going forward. And we're going to take a look at how each of these companies address each of the consistency and durability questions that I put forward here. So American Tower, who are they? This is one of the largest tower REITs in the world. It's a real estate investment trust. They own over 225,000 properties across the world, including the United States, India, and Brazil, but also throughout South America. They're huge globally. And what they do is that they own real estate, and then they own the towers that sit on that real estate, which is then leased out by some of the biggest mobile carriers in the world. So T-Mobile, Verizon, AT&T, Telefonica in South America, the biggest mobile carriers that are well known by consumers, they lease these towers and install their satellites on these towers here, which then communicate mobile data for all of their mobile customers. So this is exactly their business model. They earn long-term lease revenue. And these lease agreements are often very, very long-term, 20 plus years, which provides high certainty, recurring revenue, also high margin revenue as well. So again, as long as you can think to yourself, well, are smartphones going to be around for the next 20 years? Probably yes. Are other data devices going to be around, for the next 20 plus years? Probably yes. If you're into the whole, metaverse sort of thing, if you think the metaverse is the future, that of course is going to use mobile data even more heavily than ever before. So this is a business that's really disruption proof here, because as long as there's a need for mobile data, American Tower is going to be right there earning highly recurring revenue. And demand for high-speed mobile data is expected to achieve a robust 20% CAGR. This is according to studies communicated by American Tower themselves on their shareholder presentations through 2028, as 5G connectivity enables an entirely new class of connected devices to be made possible. So again, this company builds these towers. They lease these towers out to multiple carriers. Sometimes you have multiple carriers installed on a single tower. So that actually increases their return on invested capital. Because if you have just one here, that's a pretty low return. But what if you have multiple? And you can see here they have 1, 2, 3, 4, 5. So 5 different carriers are leasing this one tower together. So it's almost like owning a single condo and renting it out versus owning a multifamily unit and having multiple tenants in a single building. That's only accretive to your return on investment. So this is their growth. You can see the consistency factor is right here. This is their adjusted funds from operations, basically their free cash flow. You can see how consistent that's been over time. Amazing growth here. This provides high certainty with recurring revenue. And then you can see, is the company investing in themselves? This is the measure of invested capital. This is a balance sheet item, and it tracks, how quickly are they reinvesting in themselves for growth. So you can see this is a very strong CAGR. They've effectively 4x'd their investments, over 10 years' time. That's a pretty good CAGR overall. So this is telling you that they have reinvested in themselves at a pretty high clip, and that is an indication of how well they can continue to grow in the future. So this checks off a number of boxes here: linear earnings per share and adjusted funds from operations growth, consistent 8 to 10% returns on invested capital for over a decade. That's the consistency factor. And then durability into the future. High-speed mobile data is an ever-growing need for billions of people worldwide. So as long as there's a need for mobile data, there will be a need for American Tower. That's, again, servicing a critical need as opposed to a luxury or a want. AMD locks in recurring cash flows from long-term lease agreements from all the world's biggest mobile carriers. Again, recurring revenue, that's another check. And, decades of experience and execution across 225,000 sites. That provides a pretty strong moat and a barrier to entry for competitors. So again, durability, consistency together, that, pretty much gives us a great sort of 1-2 punch into American Tower. And this is the reason why we own American Tower in the Zacks Earnings Certain Proxy. The other company I talked about mentioned Checkpoint Software. This is one of the pioneers of network security with the advent of their Firewall 1 product. They basically invented and patented that particular approach to network security. What does Checkpoint Software do? They make both hardware and software for network security. So they make firewalls and software that provides robust network security for all sorts of organizations. So cybersecurity is expected to experience long secular tailwinds as it's becoming a necessary expense for organizations of all types. Remember, companies are carving out budgets for cybersecurity because this is an ever-growing need. We hear about, security breaches. We hear about data leaks. We hear about, people getting hacked all the time. Identity theft. Companies that have had, security breaches and therefore have been, subject to data losses. So organizations of all types, throughout the S&P 500, and smaller companies as well as private companies and nonprofits. Everybody is carving out a budget for cybersecurity, and Checkpoint Software has been right there in the center of that ever-growing industry. Also, 30 to 40% of Checkpoint's revenue is recurring subscription revenue. So that's another data point that you would have uncovered if you look at their investor presentations. But look at Checkpoint. They've been in the fold here for 20 plus years. This has been their earnings per share growth. You can see that even through recessions, nothing is nothing is placing a dent in their earnings per share. The COVID crash, nothing. 2008 great financial crisis, nothing. Current environment of high interest rates from the Fed, economic uncertainty, recession risk, nothing. So this is exactly the type of thing that we want, exceptional consistency. And then return on invested capital, look at the rate of change of that, 26% and increasing over time. That is tremendous. This is a business that's, very consistent and highly efficient with their capital. We'd love to see that. So let's do the quality test. We've got the consistency there, and then the durability. Again, is cybersecurity a need or a want? I would argue that it's a want. I would argue that that's a need. It's a necessity. It's not a luxury. And Checkpoint is right there among the pioneers in the field. They were actually recently awarded, as a leader in 2022 by Gartner, which looks at, the effectiveness of companies, by the industry that they are in. So within network firewalls, they were, granted, they were labeled as a leader, not a follower. So that's an excellent designation to be a leader in an industry that is overall growing and is expected to continue to grow for the foreseeable future. Again, highly recurring revenue, 30 to 40% of revenue is recurring in nature. So that gives us, increases the certainty that, that earnings can continue. 3 decades of experience and execution, that provides a very strong moat in the form of established relationships, with over 100,000 clients. Therefore, it has high switching costs as well. Because remember, if you're with one provider, chances are, as long as it's working well, which it has been, you're not going to switch to another provider. If something is working well, why change it, right? And that's, very much the case with cybersecurity. If you've been with one company, you're going to stick to it. You're not going to change. If it ain't broke, don't fix it, as they say. And Checkpoint Software has, not just 30 to 40% recurring subscription revenue, but they have, 95% client retention. So that means that, these 100,000 clients were the same this year as they were last year. So again, that tells you that there are switching costs as well as just a very low need to switch. So again, that provides additional confidence in the company's durability. So the Zacks Earnings Certain Proxy is a list of 75 such high-quality businesses that exhibit extraordinary consistency and durability. So if you are looking for ideas like this, who are other companies like American Tower, like Checkpoint Software Technologies? Who else has this type of, timeless durability and timeless consistency? These are some of the companies in the portfolio that we have of exceptional quality companies that have delivered high growth, high performance in all economic environments, companies that have a strong moat, companies that therefore have high durability in earnings. These are some of the companies that are in the portfolio. And so if you're looking for, more ideas on other companies like that would serve as tremendous long-term investments that beat the market over a complete market cycle, in our view, the Zacks Earnings Certain Proxy is a great place to do that. So if you are interested in getting more information about that, please do reach out to us. You can see here just, a sample of these 4. look at how these companies perform. This is earnings per share. We're not talking about revenue. We're not talking about fancy accounting adjustments. We're not looking at adjusted EBITDA or adding back certain expenses, things like that. This is earnings per share. You can see Global Payments here, Checkpoint Software, Mettler Toledo is another one of my favorites. These companies just do one thing. They compound growth over time, regardless of what the macroeconomy is doing, regardless of where interest rates are at, regardless of where the dollar or the euro or the Japanese yen is at, regardless of whether banks are, failing or doing well. These companies just, continue to execute at a high level. These are the types of companies we like to own long term. So if you're interested in learning more about this portfolio, please do reach out to us. Or if you have any comments or questions, or have a suggestion on a future video idea, please do reach out to us. I'd love to hear from you. If you're a ZRS client, please send us an email at zrs@zacks.com. Or if you are an Advisor Tools client, please send us an email at zat@zacks.com. Thanks everyone, and talk to you soon, and hope to see you for the next one.